All right. Here we go. Uh, First of all, good evening to everyone. My name is Kimberly Nicole Evans, and I am the CEO of Seismic Transformations in addition to Beck Evans and Associate Limited. And I want to welcome you all to today's live stream. So, on today, we are actually going to be addressing debunking myths when it comes to access to capital. And let me just give you guys a little bit of a rundown on my background when it comes to being able to speak on this subject. I've been in lending for well over 18 years, in addition to being a CFO of a middle market company myself. So I've been on both sides of the table when it comes to actually having to be a banker and work with entrepreneurs that are in need of capital, and also as an entrepreneur who was seeking capital. So I've been on just about every side of the table. And then even now as the CEO of Beck Evans and Associates Limited, we offer, of course, capital products to entrepreneurs up to 20 million in proceeds, and even beyond for those individuals who are actually wanting to raise capital. We can raise capital into the to multiple millions as well. So I want to address really what is truly the root cause of the conversation around access to capital. You're going to have lots and lots of opinions when it comes to this subject. And of course, money is personal. Money is personal. Money is very emotional. And for those people who have been able to get the loans that they need or raise the capital that they absolutely need, they're happy. They would absolutely tell you it may not be the easiest thing in the world, but it is absolutely possible. And then you have those individuals who have not been able to either get the money that they need through whatever means, traditional, alternative, and other forms of raising capital, whether it's through the equity instruments or debt instruments. And so those people or those entrepreneurs or individuals who have not been successful for one reason or the other, of course, they have a different attitude when it comes to this subject. And there really isn't there's no need to go into who's right or wrong, but then there's just facts. And the fact of the matter is that access to capital is not limited to certain people, especially because of your ethnicity or your background, or anything of that nature, gender or sex. What happens is that when we're working with entrepreneurs and we're speaking with entrepreneurs, there are other resources, there's other information that they may be missing that is preventing them from being able to get to the capital that they need. So today we're going to be talking about that, just that. There is no lack of financial access to capital. And we want to start rethinking access in a modern economy. And what does that access look like? And I'm coming to you, I don't know if you're, however your live stream is showing up, but I'm an African-American female, black female, so, and a former corporate banker. So it's absolutely no reason why I would want to spread false information, and or I don't want it to continue to give individuals any indication that there is something preventing them from seeking the capital that they absolutely need. So who is this for? This is for entrepreneurs, founders, small business owners, startup teams, even policy leaders, because a lot of the information that is out there and narratives around capital are being pushed by people who are actually coming up with the policies. Now, are there obstacles to seeking capital? Absolutely, especially if you are not aware of where your capital should most likely come from. And once you are aware of where your capital would most likely come from, then how to qualify for it. And so that is a completely different conversation, and we will be having that conversation today. We're not going to solve all of these issues within 1 hour live broadcast, but I want to be clear on my position on this, is that there isn't any type of systemic racism, sexism, genderism, whatever you want to call it, that's out there in the market today that is preventing people from seeking capital. capital will find a source in terms of where can it go to grow. Those individuals who have capital, whether they're institutional or private, and they are in a position whereby they want to invest or lend, their purpose is just to do that. It's to invest or lend, and at some point they want to win. Depending upon the position that they're taking up, they either want to be able to recoup their investment in some form, or if they're from a lending position, they want to be able to get their money back plus some interest plus their original principal. Equity investors have a different story they tell. Oftentimes, it's not all about being able to win on every investment. They will take a chance on 10 investments and have 7 of them really not perform or produce, but those other 2 or 3, they can knock it out of the box, and it makes up for anything that they could have put into those other 7 businesses that didn't perform. A lender, on the other hand, doesn't have the opportunity to have 7 out of the 10 businesses that they lend to potentially fail. So of course their due diligence is at a much higher stake and a much more stringent process than that of an equity investor. They have 2 different outcomes that they're seeking, and so individuals just have to be aware of these things when they're out in the market seeking capital. So let's just start with reframing the myth. First of all, capital isn't missing. If anything, capital is actually misunderstood. Again, capital is not missing, capital is misunderstood. So, if capital is truly scarce, how is it that so many new ventures are being funded in record numbers? Again, let's just break this down. Let's look at this from a matter of fact versus myth. If capital really is so scarce, then how can we justify the number of new ventures that are being funded, not just in the US, but just across our globe? So it's not a matter of scarcity of capital. So there is no shortage of money. There's only a shortage of knowledge on how to access the capital that you need and to qualify for it once you have identified the best match or matches for your particular project, your particular need, which there is no one box that everything fits into. So that being said, why does the lack of capital narrative actually persist? Well, from a psychological and historical basis, many entrepreneurs default to thinking that money is the issue. Many entrepreneurs will automatically think that it's something that's on the outside of them and that it's money that is the issue. And then, of course, there's media bias, right? Media will tell the story of the few heroes that are out there, but a great story is the story around I couldn't get funded. And the I couldn't get funded stories most often will get more attention than the ones about individuals who are actually getting access or seeking creative funding solutions. And it's kind of the same thing. If you have an attitude, if you have a mental attitude that I'm not going to get funded because I'm this, that, or the other, well, of course, every story you see or everything you attract is going to be around people who haven't gotten the funding that they need. No differently than when we say, oh man, I haven't seen a red Ford or a red truck today. The next thing you know, every other vehicle you see is a red truck. You are attracting these things to you in regards to the negativity. Also, there's just the traditional gatekeepers, right? Banks, VCs, equity investors, often back, what they call similar profiles. And so there is the perception of biases around this subject. And then, of course, there's just also just risk aversion. And I am nowhere near naive to say that there aren't situations where there are investors and there are maybe a particular group of people, whether it's by your ethnicity or by your race, and you continue to hear the same things over and over again, whether they're questioning the quality of your team or whether they're questioning your readiness, et cetera, et cetera. Does that happen to some groups more than others? Yeah, I mean, it probably does, especially if you are amongst a company of people And it doesn't have, again, it's not so much as your racial background. If you have not been amongst a company of people who have a history of success or come from an environment where there has been whether it's collegiate, whether it's institutional, that has a history of success around a certain industry or a certain field, there are going to be questions, though, absolutely. And so rather than just saying people are, or these individuals are biased, they are against me, do your homework. If you know that there are going to be some objections, that's just more and more reason for you to be doing your homework and to be able to look at different ways that you can establish that credibility. Because there are people, whoever you are, there's someone who looks just like you, similar background, age, ethnicity, race, gender, and they've gotten funding, right? They have gotten the funding that they needed. So let's not play games in wordsmithing. And a lot of this comes through media. And the pink elephant in the room is a lot of this information comes from the very groups that say that they are the ones that are being discriminated against or finding bias. It's a perpetuated story that the media grabs onto, that other people in certain fields grab onto, and they take it all the way to the bank. And what I say, take it to the bank, they ride it out to get to leverage the information or the story so that they can get out of the deal what they want to get out of the deal, whether it's a venture fund or whatever it may be. And then they leave everyone else hanging. And then the facts are just that. Most of these venture funds that were quote unquote created for people of a certain ethnicity don't really lend money. The majority of the people that they have lent their own money to don't even look like them. And these are just facts. And so it is what it is. And so let's focus not so much on the negativity, but get into truly what's the heart of the matter is that capital is everywhere. Capital is everywhere. You would hear people say, well, VC funds are not, not lending as much as they have in the year before and the year before. That may be true, but there's absolutely no truth around there not being money available, right? VC dry powder. That's always going to be VC dry powder. And what do I mean by dry powder? Unused funds. Unused funds within VCs is at an all-time high. And there are several micro and macro issues that are surrounding that. But again, it has nothing to do with the fact that the money is absolutely not available. Crowdfunding platforms raised $17 billion plus in 2024 globally. Crowdfunding platforms raised $17 billion plus in 2024 globally. Angel investing networks are expanding beyond major hubs. Government stimulus, grants, and incentives are bigger than they ever been post-COVID. So again, there is no lack of money. More facts. Global VC funding in 2024 was surpassed $350 billion deployed. Global VC funding. U.S. SBA loans in 2024 alone, 44 billion plus. In SBA loans, over 600 CDFIs, which are CDFIs are alternative lending institutions to your traditional banks. There are over 600 active CDFIs in the U.S. serving quote unquote underserved communities. Over 600. Over 600. I didn't say 6 or 60. Over 600. So there is no question that there is capital available no matter where you fall within your industry type, your ethnicity, your gender. There's no argument around this. And again, I've already discussed that there are certain institutions, even the individuals who claim to be victims, who continue to perpetuate this language because it serves their needs in one way or another. So even when we say underserved, underestimated communities, these are just communities that would have been left out of the information and relationship part of capital. Capital is not black and white. There are other parts to being able to access capital. And then there's also just different types of capital, right? So let's talk about different types of capital. Equity capital. There's venture capital. There's angel investments. There's friends and families, right? There are accelerators. Everybody's heard of Y Combinator, Techstars, right? The pros of these type of institutions is they also involve mentorship. This is equity capital, so this is not a loan, right? So it's not a matter of having repayment terms when we start to look at these types of institutions. We're not talking about repayment terms. Now, what are the cons? There's dilution, right? Yes, you're going to have to give up some of your equity, but I would rather own 20% of a $2 billion company than I own 100% of a $2 million company. You do the math. Do the math on your own. Oftentimes, within certain groups of individuals as well, communities, groups, they're more risk adverse. And then, as my grandmother would say, some people just have bad understanding. Their understanding about things is bad. And they think that in order to be wealthy or in order to maintain wealth, that they have to have 100% or 100% of something, and that someone should be able to take a risk. And think about this: when you have individuals who think that someone should take a risk with capital, equity capital, and not somehow want to have to participate in the equity, in the ownership of the venture that they're taking a risk in, that makes no sense. Of course they want some of the ownership. And so you have individuals that want to go out and raise equity, but somehow, some way, they convince themselves that they don't have to give up a percentage of the ownership of the company, or they don't want to give up too much of the ownership of the company. And there are ways that you can work out control over a company from a management perspective versus someone having a majority ownership over an equity perspective, which is or the stocks or preferred stock of a particular company. And so these are things that can be worked out. So the pros are you don't have to pay back equity. It's not a repayment type terms, principal and interest, etc. And then there's also additional mentorship that comes with that. The cons are dilution, right? And then also there is the expectation of hyper growth. There is an expectation of hyper growth around venture capital. There's an expectation around growth, potential future growth from private equity. So there are absolutely those types of expectations. And then, of course, there's debt capital. This is the part that most people are familiar with. You have bank loans, you have SBA loans. SBA loans are government-backed financing, right? And then you have micro loans, companies like Kiva, also CDFIs. CDFIs are community development financial institutions, which are oftentimes they also have unused funds or funds that go non-deployed. And it's wonderful that CDFIs exist, but it's also CDFIs are very specific towards who they can lend to, and they're typically for what we call underserved or underrepresented communities, in addition to groups that are defined in different ways, and each CDFI is different. So the pros is that you don't have to give up equity, right? We're talking about debt. It's also predictable. Oftentimes there's a set repayment schedule. You know exactly what you borrowed and exactly how you have to pay it back. What are the cons? Yeah, there's often a small box in terms of who can qualify for this type of debt capital, for the simple fact that the person who lent you the money wants their money back. And oftentimes I'll hear from entrepreneurs, well, I banked with such and such for 30 years, 40 years. I opened a business, then I went to get a loan for my business and I wasn't able to get a loan. Well, in those 30 years, how much time did you actually spend researching the types, not only the type of loans, but their typical client, right? You can ask questions of the institution rather than just filling out an application and hoping for the best. You can ask questions when you're sitting in front of a banker, whether it's at a branch or a small business lender. Talk to me about clients that have businesses that are similar to mine, right? They can't tell you a name, but they should be able to explain to you, yes, we lend to contractors. No, we don't lend to contractors. Yes, we invest in commercial investor real estate. No, we don't invest in commercial real estate. You can ask questions. You go to a doctor, and before you just you before you go into the doctor, oftentimes most people will ask you questions. Hey, how long have you been practicing? This, that, or the other. Same thing with your bank. You can ask questions. And before you sit down and start filling out an application and potentially get your feelings hurt, you can ask questions. Not all banks lend on investor real estate. Not all banks lend to contractors. Not all banks lend on government receivables. And here's this is again, it's about knowledge. And you can ask questions before you get started with filling out applications. So there's SBA loans, right? There are approved SBA lenders out there. And I want to be clear on this. The bank is not an SBA lender. They actually just facilitate SBA loans. The SBA will come in and back a percentage of the loan, which oftentimes for entrepreneurs who are either in a more hard to lend industry, or say carries a little bit more risk. The benefit of the SBA and the government backed loans is that it helps entrepreneurs not to have to put down as much in terms of a down payment. You get more favorable amortization terms, and sometimes you even get better terms when it comes to fees and things of that nature. You can also negotiate fees with the bank. You don't have to just accept the first number that they throw out. You can negotiate none or very minimum on those fees. And we talked about microloans. So the cons of debt is, of course, it requires credit worthiness. No, you can't have a 550 and go into a traditional bank, a 550 credit score, and think that they're going to lend you money. You don't even pay your own bills back. For whatever reason that you haven't paid it back, a 550, for those of you who aren't aware, credit scores go up to 800. A 550 is not good. So no one's going to take a chance on you, and you haven't even take you through the process of an application, and you haven't even proven that in other areas of your life you pay your creditors back. So yes, credit worthiness is important to someone. And I often give the example: if you had $1 million and you knew that your neighbor across the street had their truck repoed, their house foreclosed on, and they come to you and ask you for a $500,000 of the $1 million that you have, how quickly would you could have to think whether or not you want to give that person a $500,000? And I don't want to hear no mess about, oh, they're good people and go to church or whatever. Who gives a crap about all that? All you know is that their house got foreclosed on and somebody repoed their truck. Now, if you're dumb enough to actually give them your $500,000, let me tell you this: the bank ain't stupid. They're not that dumb, and they're not going to lend money to someone who hasn't proven that they cannot pay back the bills that they already have. And then, of course, the cons is that there's repayment risk, right? From your behalf, there's potential that your business will not do as well as you think it's going to do. There's things that happen in the economy that may be beyond, oftentimes beyond your control, or recession or whatever. And you're still on the books, and you're still the person that is responsible and accountable for repaying that loan, regardless of what is happening in the economy, or even you may get sick and may not be able to run the business or do the things in the business. It still doesn't relieve you of the obligation that you have to pay them back, right? And so now we have non-dilutive capital. Non-dilutive capital are grants. You hear about businesses that will go out and get grants, and there's all types of reasons for grants. It could be research grants. There could be grants out there for businesses in a particular area, whereby they either the local governments or the federal governments are trying to motivate entrepreneurs to develop manufacturing in particular areas. And of course, there's contests and competitions. You have people that are pitching all the time, and then there's of course tax credits and incentives. So that's an example of non-dilutive capital. And just a word on individuals who are pitching, who continue to pitch. If you have been in business for more than 3 years, and you're still entering pitch competitions to raise capital for your money, two things have absolutely happened. You have not proven product market fit, or you haven't proven service market fit. And there are some other things that are fundamentally wrong with your business model. You should be at a stage where you're producing enough revenue 3 years in, 5 years in order to be able to sustain your company, especially if you're not spending dollars on research, additional inventory, things of that nature. If you have a service type business and you're not producing anything, there is absolutely no reason. And I know people who are professional pitchers, and they have been pitching for 10 plus years. And at this point in time, let's just call a spade a spade. You just out taking people's money. And that's exactly what you're doing. And you're using your business as a front to go around and get free money. And so you have people that do this who are professional pitchers, and they enter pitch competition after pitch competition after pitch competition. Every time you see them win, they go on a vacation or they have a better car than the one that they previously had. And I'm just, hey, if you don't know me, Kimberly Nicole Evans, I'm going to tell it like they say TI is, right? And so you should not be out there, and individuals who run these pitch competitions, they should ask these individuals for proof of how long they've been in business. And if you've been in business for 5+ years, you shouldn't even be able to enter a pitch competition. That really is for people who are in startups. And so one of the things about this non-dilutive capital is that oftentimes they're abused or they're underused. They're abused when it comes to the pitch competitions, and they're underused, especially when it comes to tax credits, incentives, and oftentimes grants that go unfunded, and they're also oftentimes overlooked. Alternative capital, right? We're just going to talk about alternative capital, crowdfunding. We all know about Kickstarter, Indiegogo, Republic, WeFunder, right? These are examples of crowdfunding platforms. They all have different criteria for how you actually get on these platforms, and there is a method to successful crowdfunding. Again, it's not something that you just throw on there overnight and think you're going to raise a bunch of money. You really also need to do your research, have knowledge of the different crowdfunding platforms, and be able to go for it, right? Fundraising. Crypto fundraising is still brand new. They're the new kids on the block. And it requires a tremendous amount of research and experts around understanding cryptocurrency, right? There's pre-sales of a product, customer funding. If you could pre-sell a product, there's always individuals who want to be early users or early adopters of a particular technology. And if you can build a community and an audience and pre-sell the product before it even is available to the consumer, that's something that you need to perhaps even consider. And that's a part of that creative thinking, right? And then, of course, there's supply chain financing, invoice financing, factoring. There's AR financing. And if you're an export importer, if you've never heard of the Export Import Bank, you need to also look up export import financing and the Export Import Bank, right? All of these things are absolutely important. And I'm not even naming all of the various ways that or sources of capital. There are so many different sources of capital, everything from merchant advance to bridge loans and bridge lending. We haven't even gotten into the particulars of the types, such as commercial, investor, so on and so forth. There are more than enough products out there that are available for every need that an entrepreneur can think of in terms of needing capital or needing finance. For every need, there is a match. And so let's talk about, as we're closing out today, and for anyone who wants to get in touch with me, whether it's on LinkedIn, Facebook, Instagram, or whatever you may be looking at the live stream through today, you can DM me. You can contact me in any of our chat areas to say, hey, Kim, definitely want more information at Beck Evans Limited, which is BECK Evans, EVANS, Ltd.com. We also offer financing to businesses up to a pretty high dollar amount that falls into the alternative space. And on a case by case basis, we also will go to our sources to raise capital. But that is a whole different conversation. It requires some really high end things. If you have patents, any type of technology that is patented could be a potential candidate for a potential capital raise. And so all types of ways that we can help businesses get prepared. But one of the things that we definitely will always require is that you go through a financial risk management consultation with us so that we can truly understand what you have and help you to understand also how to match your needs to the capital that is most likely going to be attracted to what industry you're in, what stage of business you're in, your business model, so on and so forth. It is not just a one size fits all deal where you just come up with an idea, get your EIN, go into a bank, and start demanding money. It doesn't work that way. So when we look at Access Pass, right? Where and how do I get it? Money is a matching issue. I say this time and time again. It is a knowledge and a matching issue. It is not all of this other BS that is being pushed around in the media, pushed around by policy, and oftentimes pushed around by the individuals who need it the most. But depending upon what stage you're in, let's just kind of look at it from a stage perspective. If you are still at an idea, and or your early stage, right? Your best bets at this stage would be friends and family. Well, Kim, I don't have friends and I don't have family with a lot of money. That ain't rest of society's problem. That's not society's problem. And society should not have to solve your lack of friends and family for you. That's a personal issue, right? There's grants and there's crowdfunding. And again, let me be very clear on this. No one in society has the responsibility to fund your idea or to fund your business. That is your responsibility, and you are accountable for raising that money or finding where that money is from. Nobody in America owes anybody anything. And in most countries, nobody owes you anything. You are the one that decided to open a business or to start a business. So the responsibility of finding capital and raising capital is on that of the entrepreneur, that of the founder, and that of the owner. It is not society's responsibility to make sure that you have what you need in order to start a business. It just so happens if you are in America, you live in a country that does provide multiple resources for individuals who are in all types of economic situations. To those who don't have the capital, to those who have plenty of capital. And again, it is just your responsibility and your accountability. But if you're at the idea stage, in the early stage, friends and family, first round, grants and crowdfunding. And even if the friend is you, if you have to work and save $10 a week, $10 a month, $20 a month, get a second job or a third job or whatever that may be, the first person putting money into your company should be you. You should be the initial equity investor in your company. And if you can't even bet on yourself, and if you don't have the discipline to go out and at least raise the capital and do everything that you can, at least to raise a percentage of that capital to get started, hey, my hands go up in the air. You get what you get, right? And oftentimes, those of you who have that attitude, you get nothing. And rightfully so. If you're at the MVP stage where you have a minimal viable product, it may not be the exact product that is going to go to the consumer, but you have a good working model, or you're at the launch stage. We're talking about angels, incubators, pre-sales, right? Angel investors, incubators, also pre-sales. If you're at the stage where you actually have some traction, you actually have a client or two, and you're generating some revenue. Now we're talking about VC, loans, revenue-based financing. Traditional banks are cash flow financiers. They want to see not just revenue, they want to see some cash flow. And there's a difference between cash flow and revenue. Revenue, of course, is at the top of the house, but cash flow is also what you have in terms of your expenses, your cost of goods sold, your minimal fixed expenses, or after you have met those particular expenses, what's left over. And you will often hear the term EBIT or EBITDA, earnings before interest and tax, or earnings before interest, tax, depreciation, amortization. So there is a standardization across the industry when it comes to measuring cash flow. And it starts with EBIT or EBITDA, right? So traction. If you're at traction, we're talking about VCs, loans, traditional, non-traditional, or alternative loans, and revenue-based financing. And then when you are at scale, right, you're at a point where you have this traction, but you're growing faster than your cash flow can fill, and or any loan or traditional loan source that you can take out. Now we're talking about private equity, right? We're talking about bigger debt instruments, as well as even potentially corporate investors. And so these are the areas that are just based upon the stages that you're in, right? New gateways to access, and we're going to start wrapping this up, right? Online investment platforms, WeFunder, Seedfest, Republic, right? There are also global funds that are targeting minorities, femtech, climate tech. There are rolling funds out there, right? And as well as syndicates on the angel list. And I didn't say Angie's list. That's for contractors. I said angel list, ANGL list, right? Not Angie's list, angel list, right? How can you make yourself capital ready? Clear financials. This is basic stuff, people. Basic stuff. Clear financials, a clear pitch deck, and a clear ask. A story, traction, timing. I put together decks, or I have my team will put together decks for individuals that we're raising money for. And these are things that I go through and I ask. And if you don't have clean financials, you haven't started producing revenue net yet, you must be able to have projections, good projections that explain your story. Where is your market? Where are your revenues come from? What are your potential expenses? And this is not something that you're going to know exactly. So that's why you need to enlist some type of assistance or help from someone who's professionally done this before, who can help you put together your projections, right? And don't tell me, oh, I don't have money for that. You have money for something. So unless you're homeless, you pay a cell phone bill, you pay some kind of bill. So stop telling people that you don't have enough money to pay for the services that are going to benefit you. You absolutely have the money. You just haven't prioritized it. So also understanding your cap table. If you have given out any type of equity already, you are going to be asked for a cap table. So you need to be able to understand who you promised equity to and who you've actually given out equity to, right? And so you have any number of real world stories that you can just Google in terms of looking at companies that have had successful crowdfunding raises. You can look these things up. There's often white papers that are out there that will teach you and almost tell you the secret to how they did what they did. Government-backed grants, right? You can research these things. So again, make sure that you are doing the homework, that you are doing the due diligence, and try your best not to listen to all of this crap that's out there in society telling you that you can't do this, that, or the other because you are whatever gender or whatever race or whatever age. It's not that. And if you get stuck on that, you're going to keep going around like a dog chasing its tail, and you're not going to get where you need to get. And misery loves company, and you're just going to find out a bunch of people who are just as miserable as you are about what it is that they're trying to do. Try to think of it in terms of the possibilities and the potential. And ask yourself, what am I missing? What knowledge gap do I have? Because there is somebody just like you who is out there raising money, who's doing exactly what they want to do with their life, and maybe even came from a worse situation that you come from. And if there's an exception, then it ain't a rule. If there's an exception, then there's not a rule to it. It's not written in the stars. So again, responsibility and accountability. Understand where your gaps in knowledge are. Seek professional help. Proximity. Get close to the people who have achieved that what you want to achieve, and or have knowledge about what it is that you need. You may not even understand what it is that you need, but you should have enough sense to know that there's something missing. And if you don't have that, like my grandmother said, you just got bad understanding, you got bad understanding. My consulting firm can't do anything for bad understanding. But if you have some good understanding and you want help, at Beck Evans and Associates Limited Company, we are absolutely in position to be able to help you when it comes to understanding relationships, when it comes to financing, as well as potentially raising the funding that you need. So hit us up, DM us, social media. I'm on LinkedIn. You can go in. I got a scheduling link. You can schedule with us. You could go to the website. You could get scheduled with us. You can contact us. There's any number of ways for people who really want to get things done. They're going to get it done. And the people who don't get things done, the way you do anything is the way you do everything. You more than likely have a history of not completing things and not getting things done. And that's nobody else's fault. So again, thank you all for listening. This is just the hard truth, the facts coming from me, Kimberly Nicole Evans. I know it doesn't sit well with everyone, but hey, it is what it is. So keep going, keep moving. And as I always say to entrepreneurs, especially businesses, there's really no such thing as a small business. You are just in a business and you can grow as big as you want to be, or you could stay or not grow. But don't buy into these concepts that people put into your head. Be all that you can be, onwards and upwards. And if you need any type of assistance, we're here. We're ready to help, and see you guys on next Monday.